got friends only wanna talk business. I got expensive, cause winning's expensive. I got expensive, cause winning's expensive. I've been winning all the war. And I've been shutting down stars.
And welcome to Put That Coffee Down. This is the Freight Sales podcast and TV show for closers in the freight industry. My name's Kevin Hill. I'm your host today. We have a great show planned out for you today, talking about volatility, market volatility with Andrew Leto, founder and CEO of Emerge. We're seeing volatility in the contract rates, in spot rates, in load volumes, and also capacity. So we're going to dissect some of that and really talk about sales and what you need to communicate to both your customers and your vendors, your carriers, whatever side of the fence you are on freight sales, how to communicate that and how to navigate that, because there's a lot of opportunities in volatility. It can be, sometimes it can be volatile, I guess I should say, right? So it can be volatile, but there's a lot of opportunities in that. There's a lot of opportunities in chaos. But what I'd like to talk about right now is the future of future of supply chain in Northwest Arkansas. That's coming up very, very quickly here, May 9th and 10th. And you can see it there on the screen. We're back in person, back doing FreightWaves events, November. I am confusing everything right now. May 9th and 10th, the future of supply chain in Northwest Arkansas. We have our spring special ticket events here, $15.95. Pick them up now. You can go to live.freightwaves.com, pick up your tickets, go register right now. Go book your hotel rooms because hotel rooms are becoming very thin in Arkansas. So that's coming up May 9th and 10th. We have some great keynotes. One of my favorites will probably be Billy Beane. He's the executive with the Oakland A's, the GM back about 20 years ago when he changed baseball forever. Data-driven decisions, and that's what we're seeing in the supply chain and transportation and logistics right now. So it's going to have a lot of very good information, really great tidbits that you can take with you. And you can only see Billy Beane by being in Northwest Arkansas, May 9th and 10th. Great networking events going on as well all through those 2 days of fun in Fayetteville and Rogers, Arkansas. This Friday, our next virtual summit is on its way. It's Earth Day, April 22nd, and for that we have the Net Zero Carbon Summit. It's going to be talking about everything that you can think of sustainability within the supply chain, from autonomous vehicles to other autonomous things that you can do. Great keynote speakers, Dan Lewis from Convoy and Joy Tuffield from General Investment Management. We also have Mark Yeager, CEO of Redwood Logistics, coming in with the industry keynote, and Leaf Logistics will be there, Samsara, XPO Logistics, the Sustainable Freight Buyers Alliance, TRAX, Truckload Carriers Association, James Ward, CEO of that organization, will be on there too, along with our very own Jonathan Hoffman, former chief spokesperson for the Pentagon. He'll be at one of our keynotes in Northwest Arkansas as well. Plus, we are giving away something here that we're going to throw up here on the screen. I'm not quite sure. It is a Vitamix E310 blender. So get your vitamins in the blender. That's a free giveaway. You can go to live.freightwaves.com, go to the Net Zero Carbon Summit. That's coming up on Friday, 9 a.m. sharp. That's when we're going to start that. And at that point, you're registered to win a free blender, the Vitamix E310 blender. So great events coming up. And we're just rolling along with our virtual summits, our in-person summits. And so Friday, we have the Net Zero Carbon Summit, and then Rogers, Arkansas coming up, Future of Supply Chain, May 9th and 10th. But we have our guests online right now, Mr. Andrew Leto, founder and CEO of Emerge. Thanks for joining us today, Andrew.
Thanks, Kevin. How you doing?
I'm doing great. How are things going for you over at Emerge?
Oh, great. We, as you know, we have one of the I believe one of the best products for shippers to run bids, and now is the best time to get ahead of your bid cycle and start running bids more often in a more nimble way. And things are going great. We've had a lot of adoption over the last couple of years of our product because of shippers needing to run more bids than ever after Route Guide started breaking down in 2021, 22. And it's been great.
Yeah, the routing guides over the last couple of years have broken down. There's been volatility on the upside coming through the market. Now we're seeing a bit of volatility come down on the downside. I have Sonar up right now. We have about 10.66% rejection rate coming down from the highs of just 3 or 4 months ago of around 25%. So we're seeing capacity enter the market. We've seen loan volumes trend down as well. So we have some volatility on the downside. Volatility is usually pretty good in our business, right?
Yeah, I mean it's good in some ways. Right now we're seeing spot volume down 25%. A lot of less demand for trucks, and shippers are going back to the route guide. So it's good for shippers because they get to use their contract rates more often and not go to the spot market. But for carriers, it's become now it's turning more towards the shipper. A shipper world where they have the power again. It's starting to flow back to the shippers where it was 6 months ago. It was on the carrier side. So shippers we see are running smaller bids, less length. Used to be everybody ran a year-long bid. We're seeing mostly big shippers running 3 to 6 months on those year-long contracts because they see if we run a year-long bid, that doesn't make sense because we see rates are going to be trending downwards in the next 3 months. So they're running more bids than ever. What used to be a year-long contract for most shippers is now turning into 3 to 6 months. So you're seeing now they're going to have to go back to bid in 3 months, but they see the rates are going down. They see the volume is decreasing for demand, and carriers are now it's really not a carrier market anymore. So let's go out there and run a shorter bid cycle, lock in our rates for 3 months, and then go see what the market's like in 3 more months. And we're seeing that across the board with most of our shippers.
Yeah, I mean, we are about to see a wave of rebids, right? I mean, we're going to see, what do you think that's going to do to the overall market once we see the wave of rebids coming online?
I think that, we're going to see contract rates are always better than spot. In the long run, it's very seldom where spot is cheaper than contract. We're starting to see a little bit of that happen now because of what's going on in the market, because with the demand being down in the spot, all these carriers that are in the spot market are now looking for loads and they're all competing against the same loads. They're bidding the rates down. There's a lot of demand for that spot freight than there was, 3 months ago. There was so much capacity, or there was less capacity. Now there's so much capacity. And we think that shippers should continue looking at their whole book of business, all their contract rates, all their lanes, and lock in the rates, but don't lock in rates for a year. Lock in rates for 3 months, 6 months. Tender. And for carriers, I think the right message should be is really don't be reliant. A lot of carriers are trying to flow back into the contract side because the spot volume is down. So it's a big turn that's happening. I've never seen such a dramatic swing of volume. It's 25% less spot that we're seeing in the market right now, 20 to 25 on most shippers, and I haven't seen this violent of swing in literally the course of 30 to 45 days. Last 30 to 45 days, the volume has just went down dramatically. So we don't know. I can't predict if it's going to keep going down. I think it's going to level off. But that means there's going to be way more capacity. And that capacity is going to be now looking for those contract lanes. The smartest shippers are going back to bid and not going in and trying to run a year-long bid on some of their lanes. They're doing 3 to 6 months. And that's what I think that shippers should do. And I think carriers should consider trying to find more contract moves because the spot market volume is swinging lower. So, and the rates are going to start going down in spot.
Yeah, it seems like it's dictated a bit by the market, not to do an annual bid right now. I mean, there's no reason to do it if you don't have to do it. 3-6 months, the way volatility is going is a very wise decision, number one. But I think that the technology that's out there to be able to do quicker, be more nimble on bidding for shippers is out there. Do you think we'll ever really get back to the annual bid cycles, or do you think that the shorter duration bids or length of time is probably what we'll see as the norm going forward?
I think doing a long-term bid cycle doesn't make sense if you're a shipper in the long run, because remember, carriers and brokers bake in. If you're doing a year-long bid, the brokers are going to bake in 10% just for volatility. Carriers don't know where the market's swinging, so they're going to bake in. So the rates are going to be higher no matter what if you're getting your long rates. If you're shorter term with your bid and you could run shorter term bid cycles, you're going to see, you won't see that bake in of the rate. You're going to get more of a market rate. And if you think that you're going to lock in a rate, sometimes you'll see a lot of lanes where shippers are paying 10% below market, and that's good. But that obviously hasn't been the case for most shippers in the last 2 years. And because of the route guide failures and the capacity getting tighter, and a lot of shippers now, the term paper rates weren't a thing. Now everybody understands what paper rates are, and for shippers, where you get all these rates and the carriers don't really back them up. There's no binding contracts between shippers and their carriers. So carriers could always go back to the spot market. Your best carriers won't do that to you. But right now, I think being more nimble with your bidding and then bidding out shorter term bid cycles, because the carriers are always going to bake in the 10 to 20% on top. If you're asking for a year-long rate, I'm gonna add 10% to this because obviously I want to be one of your good carriers. I want to accept all your freight, but I'm going to bake in a higher rate for the next 12 months than I should. And that if you're asking for 12 months right now, where rates are swinging lower, rates are trending down for spot and contract. It's turning. It doesn't make sense at all. So it makes sense to do if you can, run a shorter term bid cycle. And that's what we're doing, obviously our product at Emerge. That's why we were able to get ahead of it for some shippers, and there's running a faster, more nimble bid cycle, and now obviously using great products like FreightWaves to benchmark your lanes. The Sonar product you guys have, that makes a lot of sense. Benchmark where you're at now. Are you paying above or below market on those lanes? If you're paying above market, but FreightWaves, we're seeing rates trending lower. Do a shorter bid, because lock that rate in for 3 months. You want the contract rate. But if you see rates are going down on Sonar, go out and find, don't run a 6-month or 12-month bid cycle, because in 3 months you're going to go out there and possibly get a better rate. I mean, that's what shippers should be doing: benchmarking and running more bids. That's what I truly believe.
That's a great point. Carriers are baking rates into the cake, for 12 months or even longer, right? But certainly 12 months, 6 to 12 months even. You're going to bake in a little bit of premium for risk, right? You're going to put a little bit, maybe 10%, as you said, for risk because of seasonal patterns, because you don't know what the market's going to do. But again, as you said, you want to be a preferred carrier. You don't want to reject freight. You want to win the contract, but you want to make sure it's profitable. But you have to bake in a little bit of a premium because of risk, where if you're doing a 3 or 6 month as a shipper, carriers can, they're more incentivized, right, to put in a more accurate pricing in there.
Yeah, and then the biggest trucking companies. If I was an asset-based provider right now, I'd be pushing for longer lock me in on these rates, because in 3 to 6 months you don't want that shipper going back to bid with the way the market's trending. So carriers it's two different advices. Shippers need to be more nimble, run shorter bid cycles. Carriers try to lock in these rates where we're at now, because it's with what's happening in the economy, less people have way less money to spend on goods and services. With what's happening in inflation. I would say lock in if you can. If you're a carrier, try to get locked into longer term contracts, and for shippers, try to be nimble as possible and run shorter term bids. Yeah,
I think when it comes to the economy, I think we are seeing signs of a switch back to at least services spending. You have inflation, you have a lot of interest rates climbing up, but I do see this move from physical goods back to the service economy. I was on a flight last night. We landed and got the news that no more masks on airplanes, right? So my connection, nice. The second flight I took out of Dallas back here to Chattanooga, no masks. I think travel will be up. I think experiences will be up. I think people will be spending more on those experiences rather than physical goods, which is bearish for load volumes.
Yeah, and I mean that's what we're seeing now. I mean, I've never seen such a dramatic decrease in the spot market. I mean, shippers that are running 100 bids a day for spot now are running 60, 70, 80. I mean, that's what we're seeing. It's about 25% down for the spot. So that means a lot of freight's flowing back to their contractor, or their carriers are accepting most of their freight volumes down. It's less going to overflow. So I mean, demand. I mean, there's just less demand for trucking. The volume's down, and both sides need to do something. A little bit. Think about it differently. The asset-based carriers, the brokers. If you could lock in rates right now, contract rates at a certain level, it's not a bad thing if you think rates are trending. I think rates are trending downwards. So, it's a good time to lock in rates. Whereas 6 months ago, 12 months ago, you would want to lock in a 12-month rate with a shipper. Now is the time to lock in rates if you can on the asset and broker side for as long as you can. And for the shippers, run as many, don't think of it that way. Benchmark your rates, benchmark your lanes, find out what lanes you're paying lower in or higher in. Notice how the trends are going in those lanes. If the rate trends are going downwards, do a shorter term bid. If they're staying relatively level in that lane, run a 6 to 12 month bid. But there's very few lanes that are trending that way right now.
There are, and I think in the brokerage or 3PL portion of the business, you're looking at margin percentage expansion right now. Locking in contract rates where you can with the falling spot market. Is that part of the cycle that we're in when it comes to 3PLs and brokerages?
Yeah, I mean, it's good time right now to lock in rates. Remember 2 years ago, brokers were losing, for the last 2 years, brokers were really getting hurt by locking in rates for a year. And that's where the bad feelings from shippers come from, is when the market flips and the brokers gave you rates, and then they have to come back to you and say, hey, we needed more money because our carriers are out there in the spot market getting better paying freight. Now's not that's, I believe in the next 12 months, that's not going to happen. I think it's swinging the other way. And I think right now, if you're a broker, and you could lock in a rate for a shipper, it's the best time to do it. If shipper's not looking for any volatility, and, you're really taking that risk of, and I think the risk is less now, where the market, if you buy a lane for a whole year, that lane's going to be in a better position 3 to 6 months from now. And you might be making, where you're making 10%, now you're making 20, 30% on that lane to make up for all those losses you had the last couple of years on freight that swung the other way, and you committed to it. And so brokers should think about it, whereas in a whole different sense than. And the same thing as the carriers. Carriers should think about in the same sense of broker. Lock in the prices you can now as demand softening, as demand for trucking is softening. Lock in the rates. Lock in your rates for as long as you can, and you'll do fine. I believe that this is the time you can do fine when the market starts swinging the other way.
So Andrew, here's a question for you. If you're an asset-based carrier or a freight broker, 3PL, what's your value pitch to shippers to lock in 12 months? I mean, what do you say? What's how do you frame it? How do you position your sales pitch to say, hey, let's lock in 12 months?
Well, no one wants volatility. Shippers want a budget and say, here's what we're going to be paying for the next 12 months. That's what they really want to do. So you take advantage of that. I mean, I could be wrong. I mean, I think, I don't think with this recent swing we've had that I am. I mean, I think demand is going to be going down further, and it's not going to get. There's no catalyst in our economy. I mean, the government's not writing checks to everybody that's going to make the demand come back dramatically. So, I think you just got to get ahead of it. And if you're a broker, just think about it that way, where you could really be locking in these rates at this level. And shippers, again, I have to, benchmark your price. I'm surprised how many shippers don't benchmark their lanes, and then look at all their lanes by lane basis, and go to some of your lanes should go 3 to 3 months. Some of your lanes should go 6 months. And if you're paying 10% or 20% below market, lock them in for 12 months. But everybody should be. But remember, shippers don't want volatility. They don't. Mm-hmm. They would rather prices stay stable than have these swings. So, carriers and brokers should take advantage of that at this point.
That they should, and I agree with you. There's not a lot of green shoots in the freight economy, let's say, for the rest of 2022, but you never know. You never know. But right. I think we were talking about it just a second ago. There's a lot of evidence and a lot of clues out there that we're going to be shifting away. Inflation, interest rates, experiences, that mix shift of spending. Switching gears just a little bit, tell us what's going on at Emerge and what are the plans for the future?
Yeah, so at Emerge, we are when I saw this problem 5 years ago in the industry, I said, there's only two major softwares there's two that every shipper uses for going to bids, and only the biggest shippers have an RFP platform. And I believe that, if they ever think about this, every shipper in the United States has a way to manage their freight through the TMS. They have and that's the execution layer. So the TMS is how you execute your freight. That's where you load all your rates, all your lanes, all your carriers, and that's how you tender out and do your tracking and execute the load from start to finish. That's the TMS. But if you ask yourself, what do shippers use to procure, find, award, use benchmarking? Should I go 3 months on this bid? Should I go 6 months? Should I go 12 months? That doesn't exist, and that's what we're doing on Emerge. We have a procurement layer that I believe is the biggest missing piece of technology in every shipper supply chain. If you ask them, so you have your carriers, how do you manage them? Oh, I've got a TMS. But if you ask them, how do you find new carriers? How do you manage your bids? How do you create your route guides? How do you know, if this incumbent did good, and use carrier scorecarding and then benchmarking to figure out what lanes to go to bid on? That technology doesn't exist, and that's what we're doing at Emerge. And I'm proud to say, the product is 90% there. Obviously, you need a lot of time to build a platform. And right now we have $10 billion flowing through our platform of shipper bids, RFPs that are going through it. Our goal by the end of the year is to have 20 billion of the 800 billion of truckload in the United States flowing through our platform, at least being bid out. And obviously bringing carriers to those contract lanes. A lot of small, mid-sized carriers now have access to shipper bids they didn't have before through Emerge platform, through our marketplace. And that's what we're trying to do. We're trying to democratize the lane so every carrier could come and join that bid. It's crazy, Kevin. The average shipper in the United States brings 20 carriers and brokers to the entire bid. And there's 70,000 for hire trucking companies. So Emerge, yes, we're giving out an RFP platform, but really what we're trying to do is democratize these bids so every carrier in the United States, every for hire trucking company has access to at least view and see what lanes they could go by. Because when you think about it, if you have $1 billion freight spend and you bring 20 carriers and brokers to a bid, you're locking. Think about all that capacity. It just doesn't know that you have that you have 10 loads a day coming out of Kansas City going to perfect, Idaho, where I go back to, and those lanes are hidden. So now you as a carrier could say, oh wow, I didn't know that this shipper there was this available freight I could find, and now you have access to bid on that freight, and it doesn't exist. And that's what we're trying to create at Emerge. Emerge is a place where I, as a carrier, can go in and bid on any lane, and that's going to create such efficiencies in the whole market. Because how many times do trucks get pushed somewhere by one broker, and only that broker and that carrier know that trucking company is going to be there, and then a shipper that only invites 20 carriers and brokers to a bid, $1 billion shipper, and there's tons of them, doesn't even know that truck is there because that's hidden data. The only people that know that are the factoring companies maybe and the broker and that carrier. So that's what we're trying to do, is democratize this to where carriers outside of a shipper's network can have access to these bids during the RFP bidding process, which I think is the most important part.
It really is. It's all about transportation, visibility, being able to see the entire market, that really transparency and democratization, and that's what Emerge brings. That's what a lot of us are trying to bring, FreightWaves as well. It's all about being able to see the entire universe of what's happening except my own little world. I want to thank you again, Andrew, for joining us today on Put That Coffee Down. It's been a pleasure as always. Run out of time here, but again, pleasure.
Appreciate it. Thank you.
That's Andrew Leto, the founder and CEO of Merge right there, talking about bids. And that's going to be a major topic going into the later half of 2022. It's going to be a volatile market, and which is oftentimes good. So with that, again, reminder, Net Zero Carbon Summit coming up Friday, April 22nd, yes, here on FreightWaves. Go register now, live.freightwaves.com. And with that, we'll see you next week on Put That Coffee Down.
I got friends only wanna talk business. I got expenses.